Hi everybody, Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. And this is our insider trading corner, I guess you could call it. So here we go from the Wall Street Journal, and you can see that on average, the buy-sell ratio is a little bit more than for every $1 worth of buys, $18.23 worth of selling. That doesn't sound too bad, except technology was for every dollar of buys, $130 of selling, and healthcare, $531.81 worth of selling. So something to pay attention to. But the stock I picked this week happens to be Disney. Now you can see that the stock is rising on declining volume, and I'm going to show you how one way that happens. And over the last 12 months worth of selling, that buy-sell ratio was 42.67. Isn't that it? Yeah, 42.63. Okay. Now, I want you to pay attention to the 3-month ratio and here I narrowed this down. So that's the same graph, but you can see a little bit better here. This is breaking down along with the other tech stocks that are. But over the last 3 months, for every dollar's worth of buys, there were 134, almost $135 worth of selling. And this time, look at this volume. It's increasing into that downward pressure. So do you think that those that have been selling out, because it's still near a high, know something at the top of the Disney scale? So understand, insiders are boards of directors, CEOs, CFOs, the guys at the very tippy top that actually understand what's happening with the corporation. But a lot of people will ask me, well, how in the world can a stock go up if there are fewer people that are buying and participating in the stock? Well, one of the ways, and I'm going to start showing you this weekly, but one of the ways that they can do it is with the futures market, which is a derivative. They don't have to own the stock. And you can see that that is at the highest level that it has ever been. So let me explain that a little bit more. We talk about the CME group a lot. So this is from them, and I'm just going to read it. The futures market leverages the stock market. Often, somebody only has to put up somewhere between 3, so an individual can do this piece, 3 to 12% in order to control the market. But each contract is roughly a 10-to-1 ratio. So let me explain that. Let's say, and this is their example here, let's say that you wanted to position $200,000 worth of stock. Well, you could go in and buy that stock and you would use that whole $200,000. Or if you used a future contract at 10-to-1, you would only have to put up $20,000 to control $200,000. So that is one way that they can push a stock up on declining volume because they're buying the futures contract, they're not actually buying the stock. Now, if you are an individual, that will cost you whatever the index is, plus, depending upon what you're doing, if it's a full contract or a partial contract, so the index plus $12.50 or $25, and then the payout is different from there. If, however, going back to this table, you are a commercial bank or a central bank, you don't have to put up 25 bucks. All you have to put up is $2.41 or $2.40 or $1.18. There you go. And if you are a central bank, you only have to put up $1.60 or $76 to control $200,000 worth of stock, just like they leverage the physical metals and oil. So that's only one of the ways. Next week, I'll show you another way, and keep those questions coming. I know we didn't do the Q&A today, but we will next week. And that's it for today. give us a call at 888-696-4653. Follow us on Facebook, right? I'm sorry, I always get this wrong, and I'm a little tired. I was working on this late. Follow us on Twitter, like us on Facebook, subscribe to us on YouTube, give us a thumbs up if you like this, and don't forget to give us a call. You be safe out there. Bye-bye.